SGX Nifty is up. We'll probably get off to a good start, but we are running into earnings starting tomorrow. So let's talk about that. Rajat Rajgarhia of Motilal Oswal has joined in. Rajat, morning. Infosys starts off the earnings season tomorrow. What are your expectations?
Hi, good morning. Well, I think this quarter should be quite okay for them, considering that when they last came in January, they had a pretty good confidence boosting guidance, which we saw into the stock also. The focus of the market will of course be now what guidance they spell out for FY14. Right now we are modeling in a organic growth guidance of 10% plus, and including Lodestone it would be more closer to 12. I think they may guide something 150 basis points lower than this. So the range of the guidance, and they typically now guide for a minimum growth. They stopped giving a range. So I think they probably speak out about a minimum growth of about 9% for this year, 8 to 9% for this year. The other important thing to watch out in Infosys would be whether they step up the dividend, because that is another thing that investors have been asking or looking into the company now.
Rajat, good morning. What if IT generally does not have a great Q4 but points to the fact that things are recovering and FY14 will be much better? Will you need to change around expectations a great deal if you hear that kind of commentary?
Well, if you look at IT, just reflect back in FY13 itself, you had a first half earnings growth of about 30 to 35%, and the second half earnings growth has been 13 to 15%, because the first half had almost a 18-20% positive kick coming from the rupee itself. Next year, if you assume rupee to be 54-55 range, then at least that is no more a big driver of the growth for them. The dollar revenue growth of course is looking better for most of the companies, and somewhere that is getting priced into the stocks also. All these stocks have been big outperformers this calendar year, but Infosys in particular. So I think people have been positive on the stocks. The consensus itself has also been positive on the stocks, and at the margin the dollar revenue growth rate outlook just seems to be getting better for them.
I see one of your other top overweights is Tata Motors and Maruti from the auto space, Rajat. They've had a miserable couple of months in terms of sales traction. What do you expect to see in this quarter in terms of numbers?
I think speaking on Maruti, this quarter you will see margins normalizing at about 9.5% for them in the March quarter. I think considering the environment we are in, the volumes for Maruti in the March quarter could have been much worse than what they reported. The kind of slowdown that we have seen on the consumption side, if they are still doing an average March quarter volume of 110, 115 on a monthly basis, I would think that's a pretty good number for them to hold on. From the next 12-month point of view, now suddenly many things seems to be working in favor of Maruti. First is the petrol diesel disparities coming down. Second, I think you will see competition besides this launched of Amaze. The other part of the competition would be more stabilizing. Third, interest rate commodity prices working in their favor. And fourth, we don't know what yen to factor in FY14, but I think if you look at all the street numbers, the estimates for FY14 is factoring in a much lower yen than what it is now. So the possibility of earnings upgrade in Maruti is very high. On Tata Motors, I think the standalone business continues to disappoint. Losses that they have been making for the last couple of quarters will continue for March and likely June also. But JLR is still holding on very well, and even the retail volumes that came for the month of March at 53,000 plus, that also at least gives you the confidence that you are entering FY14 on a reasonably strong footing. It will take a time for the domestic volumes to recover, but I think the damage to the overall earnings is very limited, considering that JLR is a very big proportion of the numbers. The stock again from the January highs of 330, 340 has corrected down to 250, 260. I think now at sub 4 times EBIT to EBITDA, sub 8 times earnings, this is again a stock which you can bet to play good upside from here.
What do you think lies ahead with earnings in the first quarter, Rajat? Because Q4, most people expect it not to be special. Do you think in Q1 we'll get concrete signs of a major turnaround in earnings, or will that continue to lag and disappoint?
Well, I think at least this is more of a guess that I'm making for Q1 right now, because I don't have concrete numbers. I don't think Q1 will see any recovery in the numbers for most of the companies, because if you look at the major components of earnings, first is banks. We are not seeing any pickup in the loan growth. In fact, that loan growth numbers may just see some contraction, only because whatever working capital cycle was picking up because of high inflation, even that number will see some correction. Second, if you look at autos, I think volumes are still not picking up. They are just holding on where they are right now. Consumption still, the March quarter slowdown will continue into June. You just may see some relief coming from companies like Reliance or ONGC or technology to some extent. Otherwise, this quarter, March quarter, we are expecting profits to be almost zero growth for our universe. At this point of time, I am guessing that June quarter will not be any different from this.
You mentioned Reliance. Do you think Reliance will have a good first quarter? Because they report next week and this quarter is expected to be good, but refining margins are apparently under quite a bit of pressure of late. Do you think that might affect Q1 performance?
Yes, the refining margins have been very volatile, and we have seen that in the December quarter itself, when refining margins generally were weak, Reliance was still able to report a fairly good premium over the benchmarks. This quarter also, we are looking at more like a 5,500 crores kind of a profit number. I think a number between 5,000 to 5,500 crore is something which is a combination of both refining and petchem, which is basically holding on for them. And we see these refining margins changing every month over month. And we are just into the first 15 days of April. So we just may see some reversal again sometime in this quarter. So I'm still not too much worried on the numbers. I think this range is something which should hold on for Reliance in the June quarter also.
Would you start reducing exposure or weightage to any of the consumer names, Rajat, given what we are hearing about volume growth slipping, or you think FMCG is still one of the best bets?
Well, in that same report that you are referring to, we have cut down our weightage to consumer again significantly, and that cut in the weightage is the result of cutting weight on ITC, because this is the quarter, this quarter numbers when we prepared for FY14, we have seen our estimates getting cut for both ITC and liver. Both the companies have seen an estimate cut of almost 300 to 400 basis points on the growth front. That is one. Secondly, if you look at the consumer pack, in FY13, the sector did an earnings growth of 19-20% versus index earnings growth of 5%. I think in FY14, you will see the index growth picking up from 5% to maybe more closer to 11-12%, and the FMCG companies growth moderating from 19-20% to more closer to 14-15%. So the big outperformance in the earnings growth in FY13 will moderate meaningfully in FY14, and that in itself will be a reason for the multiple premium of these companies over the index to moderate. Recently, we also downgraded our rating on Asian Paints. As I mentioned, we have cut our weightage on ITC. So at least we don't see many of these stocks providing any absolute return over the next 12-month period, and the rest of the market has fallen enough to provide absolute returns in some of the large caps.
These were some of the few names, though, that were keeping the market's valuation band afloat, Rajat. I mean, and the valuation argument in any case is tricky. Would you say by the end of earnings season, there may have to be a bit more in terms of valuation contraction because of what we see in terms of the quality of earnings?
Look, if you look at now the three sectors, technology, consumer and healthcare, these three sectors put together as a percentage of overall market cap, and I'm not doing any free float, this is absolute market cap, that has risen by from a ratio of almost 25% few years back to now about closer to 35%, and on an average these three sectors trade at 20p FY14. So we are saying that if the aggregate market is trading at 13.5p and 1/3 of the market is at 20p, so then 2/3 of the market is trading at about 9p or even lower than that. So and we are talking about the Sensex, some of the big names right now. Sub 9p in a moderating cycle is anyways very attractive, and somewhere I think maybe June quarter would really be the bottoming out quarter for many of these companies on their growth front. With some easing or some improvement at the macro front, you should see things getting better. Valuations will bottom out a quarter before you start seeing earnings bottoming out for the companies.
Stay on, Rajat. We'll take a break and come back and discuss more stocks. Still about 15 odd minutes to go for the pre-opening, which should be a good one for the market this morning.
Welcome back. Things are okay across Asia, like we've been telling you. SGX Nifty also trading with some green. So let's see how it is for us once we open up for trade. That's the Asian screen for you right now. Rajat, one pocket that performed last quarter but since then has seen a big drop in sales is the cement sector. How are you guys approaching that?
Well, that's been a real surprise over the last three, 4 months. If you look at till September quarter, that sector earnings was growing at almost 25-30%. December quarter saw some decline, and now March quarter will again report a decline in earnings for the companies. I think somewhere it's a lagged impact of the kind of demand slowdown that we have been seeing in the system. Just about a couple of months back, we downgraded Ambuja because we thought that it needs to price in some of the slowdown factors which have been cropping up. But the correction in the stocks have somewhere become very severe. I think at some point of time over the next 3 months, you would see investors start looking at this space again, because if you look at, for example, companies like ACC at about $90-95 EV per ton, companies like Ultratech at about suppose $120-130 EV per ton, Ambuja in a similar band, they all will be trading at quite below their replacement cost. And at least in the second half of this year, with fair bit of election spending, you should see some demand picking up. So maybe a temporary period for cement valuation correction is more severe, and good time this quarter for people to start picking up stocks again.
Thanks, Rajat, for your thoughts. Ambarish Baliga and Amit Trivedi have also joined.